Welcome to Meow Money, where we turn tricky finance into fun, bite-sized tips. Let's dive in.
Imagine building your portfolio like raising a tiny cat village. Each kitty has a job, and together they keep your future purring smoothly. We always start with your goals. Long-term goals give you more time to ride the market roller coaster. Shorter goals? You want more stability so your money cat doesn't freak out. Then comes risk tolerance. As we mentioned last week, are you a brave tiger or a gentle house cat? But there's one more important factor: age. Generally, the younger you are, the more bounce-back time you have, which means you can let your portfolio explore more, aka more stocks. As you get older, your portfolio should gradually add more bonds, like giving your money cat more soft pillows and fewer cliffs to jump from. Now let's meet the portfolio team. Stocks, the adventurous kitty, high growth but dramatic mood swings. Bonds, the calm kitty, steady, predictable, great for stability. Cash, the emergency kitty, doesn't grow much but always ready to help. Here's the quick one-page portfolio splits between stocks and bonds. 80 and 20, long-term tiger, 60 to 40, balanced and adaptable, 40 to 60, cautious cats close to goals. Once you choose your mix, remember, this isn't set once and forget forever. Portfolios drift. Your 60-40 might quietly wander into 70-30. So give your money cats a grooming session every few months. Best, quarterly rebalance. Still good, semi-annual. At minimum, annual checkup. Final Purr takeaway. A good portfolio is simple, calm, and consistent. Pick your mix, stay the course, and let time work its compounding magic. Here comes the homework. Choose your target allocation, plus set a quarterly rebalance reminder so your portfolio stays in perfect shape.
Thanks for watching Meow Money. Like and subscribe to keep your savings purring. See you next time.